Hey, Michael, how are you, man? You there, Revo? Hey, Julian, how are you, man?
I'm really good, thanks, Scott. I did see your post, but I thought I'd come on anyway because rather like martial arts, every now and again, it's still worth doing the basics.
Every now and again, the basics do cover you. While we're waiting for people to turn up, why, um, Julian and Michael, like, what are the areas that you're still struggling with? Like, what is the stuff that could be clearer that I can clarify yeah, let's.
Well, I did have a couple of questions for you, but it's not directly related to the system. The first was, so I bought some Dogecoin about 6 years ago, and I was just buggering about learning a little bit about crypto, and I'm looking for the key at the minute, and I've basically the old wallet doesn't work. So your seminars on that, on building a system, have rekindled my interest in crypto. So I'd like to get back into that. And the other thing I wanted to just ask briefly is, in terms of financial management,
Yes.
I've got money in. So I've got money in shares. I trade your system. I've been doing the indices, but I'm going to dial that back a bit, and I'll still be doing swing trading on the shares. But in terms of your overall portfolio, you've got money in crypto as well. What sort of percentages in terms of your overall wealth do you put in each thing?
It was quite low, but it's done very well. So, I guess, so what have I got in crypto? A touch under 300K. So I would have said about between 2 and 4% of crypto was about right. But that's getting up towards 10% now. So I'm probably a little bit overweight crypto personally right now. But I'm probably going to stick with it because it's showing signs that it's a good thing.
Yes, a lot of opportunity, isn't there?
Look, I don't want to go, all full retard and like crypto's the future and it's the future of money. Like, I don't believe any of that stuff. What I do believe is that crypto has a viable use case, and the use case is the same as it's always been. It's been money laundering, sanctions busting, hiding assets from governments, hiding assets from your wife, not paying tax on stuff, and criminals laundering money. And historically, those are really big businesses. Like, historically, Switzerland hasn't done anything else for like 500 years other than those things. and they've made out perfectly fine. So I see crypto as being not necessarily the future of money or any of that shit. I see it as being, a couple of percent of global GDP, and that would make it a real market. But it's also like a market from like 100 years ago. So you can tell that it's crooked. You can tell the way that it behaves is heavily manipulated. You just have to take it. It's not something to put 100% in the market, for sure.
Brilliant. Thanks, Scott. That helps.
Yeah. Okay. So as far as the system goes, all right. Let me just. Guess I'll just start teaching from the beginning. Okay.
Mm-hmm.
Everyone cool with that?
Yep.
All right. Okay. So from the beginning, what we're doing is we have a 2-minute chart on the left-hand side. We have a 5-minute chart up here, and we have a 10-minute chart. The indicators that we're going to be using are a Bollinger Band, which has the standard parameters 2 and 20. We're going to have an 8-period exponential moving average. We're going to have a 21-period exponential moving average. And we're going to have a 14-period average true range. Okay. I'll just repeat that. We're going to have 2 and 20 Bollinger Band, which is the default. We're going to have an 8-period exponential moving average, a 21-period, 14-period average true range. We're going to have a 2-minute, a 5-minute, and a 10-minute. Now, most of the time, we're going to be trading mean reversion off these Bollinger Bands. But if you look at the way that the price bounces off these Bollinger Bands, you can see that price reasonably respects these, but not exactly. Like, for example, if you went short here, you'd be with a stop loss here, you'd be immediately stopped out. If you went long here with a stop loss, you'd be immediately stopped out. So just waiting for price to hit a Bollinger Band and then shorting it is a non-viable strategy. So, for example, if you just waited for price to hit this and then shorted it, you'd immediately get stopped out. If it hit it there, you'd immediately get stopped out and immediately get stopped out again. So it's so we need a way to say that the Bollinger Bands are roughly right most of the time, but we can't just jump in. So we need something more And the something more that we're having is one of two patterns. And the first pattern that I'm going to teach you is we need a touch of the lower, for a long, we need a touch of the lower Bollinger. We need 3 things. 1, touch of the lower Bollinger. 2, 1 or more higher closes without breaking the low of this Bollinger Band touch. 3 is the lower close. Lower than what? Lower than what? Lower than the previous bar. So we have a 3-step process. Touch of the lower Bollinger, higher close, lower close. When this is complete, we go long at the nearest half pip or 4 pip above this bar height. So if I put my mouse over here, you can see that the high is 1.22506. Now, there's an easy hack to avoid getting confused by these like big FX numbers. So when it says 1.22506, what that really means is that it's €1, 22 euro cent, 1.22 and 50 euro cents, 50.6 euro cents. So you can make it easier for yourself by only reading the last 3 numbers. So if I look at the last 3 numbers, a 506, and in my head, I want to read them as 50.6 instead of 506, because that's what it is, it's 50 pips, 0.6. So the nearest half pip or 4 pip above 50.6 is 51, and the stop loss is the nearest half pip or 4 pip below the low. The low is 47.3. So the nearest half pip or 4 pip below 47.3 is 47. So our stop loss is 47, our entry point is 51. So we're risking 4 pips. Okay. And we go long here, stop loss here. Now, let's look at the same thing in reverse. So in reverse, we have a touch of the upper Bollinger. We have a lower close without breaking this high. And then we have a higher close without breaking this high too. And we go short here, stop loss here. Now, we go short on a stop order or a stop limit order. I prefer a stop limit order. Some others prefer a stop order. There's pros and cons, which I'll cover later. So the low here is 60.7. So the nearest half pip or full pip below 60.7 is 60.5. So entry point is 60.5. Our stop loss is the nearest half pip or full pip above 63.6, which is 64. So 64 less 60.5 is risking 3.5. So I'll just let some more people into the room. Okay, so let's look at another few examples. This is the nighttime action, so it's probably a bit thin. Okay, so let's say again, we have a touch of the lower Bollinger. We need one or more higher closes without breaking the low of this bar. Now, it doesn't matter if we have multiple closes. We can, this setup is valid for 20 bars from this low. So one or more higher closes, we have it right here, this close, 41.8 is higher than this close, which is 41.7. We have another higher close, another higher close. We're waiting on a lower close. We place our order to go long at the nearest half pip above the high. The high is 46.1. We go long at 46.5. And we look at the next bar. The next bar didn't get to 46.5. The next bar only got to a high of 45.9. So what do? We resize our position. We recalculate the position size. And we place our entry point at the nearest half pip or full pip above the high of this bar. So this bar, the high is 45.9, so the nearest half pip or full pip above 45.9 is 46. Our stop loss is 41, so we're risking 5 pips. Is that making sense to everyone? I'll do a couple more examples to make sure everyone gets it, because this is fundamental. So we see the same thing here. This time it's a losing trade. We have a touch of the Bollinger. We need a higher close, which we have. Now we're waiting on a lower close. We place our order to go long at the nearest half pip above here. Stop loss, the nearest half pip or full pip below here. It's not filled. We move our order down to the nearest half pip or full pip above the next bar. So in this instance, we start off going long at 49 with a stop loss at 43.5, which is 5.5. And then we move our entry point from 49 down to 48. So the implication of that is kind of interesting. So whatever target we're going, by moving the entry point 1 pip closer, our target is in effect 2 pips closer to make the same risk reward ratio. So anyone who hasn't got that yet, do you want me to move on? Or are we good? Are we good? Just type yes or no in the chat. If I get any no's, we'll do a few more. So type in the chat if you're good. Okay, someone's good. Okay, Tema's not good. We'll do a few more then. Okay, so let's look at it again. For a long and shorts are treated exactly the same in the system, just reversed. So here we have a 3-step process. Step 1, touch of the lower Bollinger. Step 2, we need one or more higher closes than the bar before without breaking the low of this Bollinger Band touch. So we've got some higher closes. We're waiting on a lower close. We get a lower close here. we place our order to go long at the nearest half pip above this bar. If it's not filled, we move it down to the nearest half pip or full pip above the next bar. It's not filled again, we move it down to the nearest half pip or full pip above the next bar. Now, this next bar, the high is 46.4, so the nearest half pip above is 46.5. And here, our high is 46.3, so it didn't get there. So we leave our order at the nearest half pip or full pip above this bar. And the next bar, the high is 46.5. So this gets us long here, where our stop loss is under here. We're in loss, in loss, in loss, and then taking us into profit. Let's look at one more. Touch of the lower Bollinger. We need one or more higher closes without breaking this low. So we've got two higher closes. We've got a lower close. We place our order to go long here. If it's not filled, we move it down to the nearest half pip or full pip above the high of this bar. So the high of this bar is 67.8. We move it to 68. And then the high here is 66.1. So we move it down to the nearest half pip above this bar until we get a fill. So the high of this bar is 1.22661 or 66.1 pips. So we move it to 66.5. We get long here, stop loss here, and it goes for a little bit. Okay. That's the first of our two mean reversion setups. Let's cover the second one. Now, what are we? I think it's important that I explain what we're trying to do with this. So what we're trying to do is find a place where it's just a little bit safer to go long. So most of the time, you just, like if you're in a trend here, you can't really just like jump in long because, you know, it's just a bad idea. It's like going counter trend all the time is just a really bad idea. So what we're trying to do is just, we're just trying to tilt the odds very slightly in our favor to make it so that this is not a terrible idea anymore. So we see again, touch of the Bollinger, higher close, lower close. We're going long when we break here, our stop loss is here. Now, Tamara, I'll get to the targets in a minute. Now, there's two problems with trading on 2-minute charts. Well, there's more than two, but there's two big ones. The first one is that the 2-minute chart is a lot of noise and not a lot of signal compared to daily charts. How do we deal with that? We're going to deal with that by requiring what we call confirming evidence on the 5-minute and confirming evidence on the 10-minute. Now, a question from Malik, what do I mean by higher close and lower close? So if you look at this bar, you can see up here, we have these four numbers are the data points of what's called candlestick charts. So open, high, low, and close. And so the last of these is the close, is the most important part of the candle. And the most important part of the candle is where it closed because that shows you who's controlling the price at the end of the bar. So when I say higher close, I mean higher than the bar immediately before it. So this close is higher than this close here. This close is lower than this close here. Okay, got that, Molly? Okay, so when I originally started trading this setup, I was trading it on daily chart patterns. And when I traded on daily chart patterns with no confirming evidence, the win rate was 62% on its own. The win rate is nowhere near 62% on its own on 2-minute charts. So we need to tweak the win rate. And we tweaked the win rate using a concept called specificity. And if you look here, when we touch the lower Bollinger, where's the, let me find out where we are. So this is 820. Scroll back to, scroll back to 820 so you can see what happened. Okay. So we have 4 different types of confirming evidence, which I'm going to cover today. The first and the most obvious one is a Bollinger Band touch. So by Bollinger Band touch, I mean that the candle that touches the Bollinger on the 2-minute, if you place your cursor on it, find the same candle on the 5-minute. You can see on the 5-minute is here, and at the same time it's touched, or it can be 1 bar to the left of it or 1 bar to the right of it. Now we look at the 10-minute chart, we have the same thing. This bar that touched it here is the same bar that touched the Bollinger on here. Now what this does is 2 things. First of all, it makes the setups more alike. So the more specific you can make a trading system setup, the more likely it is that these things are going to be alike. So Tama has a question. These 3 candles touch the lower Bollinger, and that's a really good question. Which one to consider? So you consider every candle as it comes. So first of all, we've got, if you consider it right here, we've got a touch of the Bollinger. We need a higher close without breaking the low of this candle. As soon as we break the low of this candle, we start the count again. So this is how we avoid just jumping in long here or jumping in long here. Okay, so as soon as it breaks the low of this candle, we start the count again, and we've got a higher close and then a lower close, and we're good, and we go long here. Okay, now let's look at the 4 types of confirming evidence. The simplest one is Bollinger touch, Bollinger touch. Now, this is problematical in many ways. It's the weakest part of the system. It's still an edge, it's still a strong edge, but it's the weakest part of the system. And I want you to consider why it's the weakest part of the system. So for this to be a winning trade, long here, stop loss here, it has to be a reversal on the 2-minute, it has to be a reversal on the 5-minute, has to be a reversal on the 10-minute. All those 3 things together are quite an ask. Consider the same thing back here at, say, 4 p.m. Let's see if we can find another example. Let's see if we can go back to, yeah, well, we haven't got an example there. Let me find one. So the point that I'm trying to make is if we're going long here, let's say we go long at the touch of this Bollinger Band. If we look at the 5-minute, the 5-minute at this point is a clear uptrend, and the 10-minute is a clear uptrend. So going long here, even though it requires a reversal on the 2-minute chart, isn't really a reversal, it's really a trend following trade. Does everyone get that? Because that's really, really important to get. So this reversal off the lower Bollinger, when we're already in an uptrend on the 5 and already in an uptrend on sorry, and already uptrend on the 5 and uptrend on the 10 is a fundamentally different thing than when we've got a Bollinger touch on all 3 timeframes. It behaves differently. The targets are different. Now, our target when we have a Bollinger touch, like here, is 1.1 times our risk rounded up or down to the nearest half pip. So let's do an example so I show you how. So here we go long at 91. Our stop loss is at 66.5. Sorry, not sorry, at 86. So the difference between 91 and 86 is 5 pips. So because we're Bollinger touch, you can see we've got a Bollinger touch on the 5 and Bollinger touch on the 10. Our target is 5 times 1.1 is 5.5 pips. So we go long here, and our target is 91 plus 5.5 is 96.5. So it's here. From Mayor to everyone, does it work in crypto? No, crypto is the fees and the spreads in crypto are too large to make this work. You could maybe make it work on a daily chart, but honestly, in crypto, there's the real money in crypto is from holding a coin when it goes from 20 cents to $2 or like $2 to $2,000 or whatever, right? Like crypto is the wrong market to be trying to like make your daily bread. Crypto is a market where you put a little bit of your net wealth in and you try and 100x it when the market has a good run. It's not the kind of thing that you can reliably count on day in, day out. This is kind of a more reliable day in, day out type system. Okay, so we're moving on. So we have 4 different types of confirming evidence. You need one on each of the 5, one on the 5 and one on the 10, at least one. So the first one is a Bollinger touch. The second type of confirming evidence is what we call a trend with pullback. So would everyone agree that this is an uptrend? Definitely an uptrend. So when I started trading the system, I had a discretionary definition of an uptrend. My definition was pretty wishy-washy, to be honest. It just wasn't good enough. And so when I started teaching the system to some algo traders who automated it, we had to come up with black and white rules to say what is a trend and what's not a trend. And so for us, I'm going to teach you the trending definition. And this trending definition is very useful for all of your trading. How do you know when you're in a trend? Here's how. Here's our definition. Trending for us is a 2-stage process. Stage 1, it touches the upper Bollinger. So you can see we've touched the upper Bollinger here. The Bollinger Band, you can see right here, is 591, and our high is 593. Stage 1, touch the upper Bollinger. Stage 2, we have a single candle with a higher high and a higher close than we've had so far. So far since when? So far since the Bollinger touch. So you can see here, we don't quite make a new high, and we certainly don't make a new high and a new closing high in the same bar. So this bar has a new closing, has the highest close so far since the Bollinger touch, and it has the highest high so far since the Bollinger touch. We start trending from this bar. Now, all of you discretionary traders, would you say that that's a pretty decent place to consider the market starting to trend? How far off from it is from where you would say if you were just like eyeballing? Anyone disagree? So, according to our definition, 2-stage process. Stage 1, touch the upper Bollinger. Stage 2, a single candle with a higher high and a higher close in the same candle. So we start uptrending here. What stops us uptrending? One of three things. First thing is a touch of the lower Bollinger. So we start uptrending here, we stop uptrending, we start uptrending again. And then we stop uptrending here. Make sense? Everyone got this so far? All right, let's look at it in reverse. We're looking for a two-stage process. Touch the lower Bollinger, stage one. Two-stage process. Stage one, touch the lower Bollinger. Two, single candle with a lower close than we've had so far and a lower low than we've had so far. So we start downtrending here. Now, if you think about it, at this point, can you really say you're in a downtrend yet? Or because it kind of looks like it could be a trading range. It could easily reverse, could easily become a new highs there, right? So where is the first bar that you really are sure that, oh, fuck, we're in a downtrend now, I don't want to be long anymore? Is it here? I don't think it is. Is it here? Yeah, I think it is. I think this is the bar where you're like, oh, fuck being long, I've got to exit my longs now. Like, this is going wrong. And you can see what happens. So let's do another couple of examples because this is important to get right. Okay. Let's look at it on the downside. So a two-stage process. Stage one, we touch the lower Bollinger. Stage two, we need a lower low and a lower close than we've had so far. We get a lower low, I think. Well, actually, we don't. It's not a lower low or a lower close. Not a lower low or a lower close. Not a lower low or a lower close. The low here is 778. The low here is 769. And the close is lower than this close. So we start downtrending here. Now, if I look at that and I think, I can't call that a downtrend yet. I just call that choppy bullshit. Now, at this point, it's still a bit choppy bullshit, but it started the process of going down. And now, what stops us from being in a downtrend? Three things stop us from being in a downtrend. Thing number one, touching the opposite Bollinger. So in this instance, we start downtrending here and we stop downtrending there. Anyone disagree with that? Anyone think that it's something different? Feel free to speak up. So what we're looking at doing here is we're looking at fixing a set of rules so that we don't have to rely on our opinions anymore. Because all of you who actually trade know that opinions are really easy when you're looking at historical charts and really, really fucking difficult when you're on the hard right edge of the chart. So my experience is that I could look back and go, I would have done this, I would have done that, I would have done this, I would have done that. This is this, that's a that, that's a head and shoulders, that's a this. But when it really comes down, when the charts are winding out and you've got real money on the line, everything gets fucking confusing and it's kind of fun. So let's look at some more examples. So, two-stage process. Stage one, we touch the upper Bollinger. Stage two, we have a single candle with a higher high than we've had so far and a higher close than we've had so far. And you can see here we have a higher high, but not a higher close. So now we need a single candle with a higher high than this high and a higher close than we've had so far, which is here. So actually, close is 582 and the close is 586. So I was wrong. So this candle actually does start us uptrending. It's got a higher close, 586, and here 582. And it's got a higher high, 626, and the high here of 590. So we start uptrending and we continue uptrending until one of three things happens. Thing one, touch the opposite Bollinger. Thing 2, we go 20 bars, excluding the all-time high, so not counting the all-time high, we go 20 bars without making a new high. So let's count it out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. At the close of this bar here, we consider ourselves no longer to be in an uptrend. Now, why do we do that? Because if this market was going to continue going up, up and away, there should be buyers jumping in anywhere around here. The fact that it doesn't, the further this trading range goes on, the less influence the previous trend has on it. So a good rule of thumb, and a guy called Al Brooks taught me this, like fucking 2008, he taught me this. His idea was that after, he was a discretionary scalping trader, and we are systematic scalping traders. But Al taught me that after 20 bars, he considered that the previous trend you should just disregard because it's not, it has no influence anymore. So I kind of like that idea, and I built that into my trading system. So we have 3 ways to stop trending. Way number 1, touch the opposite Bollinger. Way number 2, we just covered, go 20 bars without making a new high. Way number 3 is the most complicated way. I'm going to cover that now. Is we have these 2 moving averages, the 8 moving average and the 21 moving average. And we need a 3-step process to stop trending. Close below both moving average, close above both moving averages, and then a close below both moving averages. We can see here, moving average, the orange moving average is 470 and the close here is 469. So in this instance, we've considered ourselves to stop trending at the close of this bar. Okay, GSANT, is one supposed to look at the 10-minute chart to confirm the trend? No. So the way that the system works is you need one of 4 types of confirming evidence. Our 4 types of evidence are Rabbit, what settings on the EMA are 21 and 8, exponential. So our 4 different types of evidence are 1, a touch of the Bollinger Band, 2, a trend with a pullback to at least the 8 EMA. Now, to understand what a trend with a pullback is, you need to understand the definition of trending. So that's what I just taught you. Is everyone clear on the definition of trending? Or can I go on from there? Anyone not clear on the definition of trending? Okay, seems like everyone's clear. Okay, so now we're going to cover, so the way it works is you've got a setup on the 2-minute. You need to check, do we have at least one of these 4 things on the 5, and then at least one of these 4 things on the 10. And the way that I personally do it is, I'll show you my results. I'll show you how and why I do it the way that I do. So this is our results spreadsheet that we work on, that we work off. And if we scroll over to the right a little bit, you'll see column AA is CE, confirming evidence on the 5 and confirming evidence on the 10. And we've got 4 different types. So if you think about all the different permutations of 4 different types, you get Bollinger, Bollinger trending, blah, blah, blah. There's a million different permutations. Well, it's not a million, it's hyperbole. But if you look at most of them, about half are Bollingers. About 25% are T's, trendings. Maybe about 12% are W's for walking. And so actually, let me just take a little Okay. So let me just show you some stats. All right. So if we just look at the mean reversion trades, we have two parts to our system. We have a mean reversion component and we have a trending component. So Bollinger Touch, 60% of mean reversion trades, but they only contribute 47% of total profit. Trending, only 27% of mean reversion trades, but 35% of profit. And Bollinger Trending, 11% of mean reversion trades, but 17% of profit. So what we can see is that Bollinger Touch, and I'll explain why, is the weakest part of the system, objectively. The other parts are much better. Why do I leave it in? Why did I leave in part of the system that is not as good as the other part? And this is why. So this is an equity curve overlaid of the different types of confirming evidence, right? The blue one is Bollinger Touch. And what you can see here is that this is not bad, but it's got very big drawdowns. This is an unacceptably large drawdown. This is an unacceptably large drawdown. The other types of confirming evidence don't have big drawdowns. This is just a flat period. This is just a flat period. This is just a flat period. And this is the trend following part of the system. It just has flat periods. So what I want to point out and what makes this system work, in fact, the secret sauce behind the whole thing is simply that trending and Bollinger Trending are totally and absolutely non-correlated with Bollinger Touch confirming evidence. And what I mean by that is that when Bollinger Touch is sucking, and all systems suck sometimes, you can see that in that specific period, trending is going through the roof. When trending goes sideways here, this is kind of shitty. Look at what Bollinger Touch is finally doing the business. Trending goes sideways here for a bit, and Bollinger goes up. Bollinger takes it in the neck, and trending at that exact moment starts to work. And so the interaction of these two things gives you an equity curve that is very, very stable. This is what we want. What we don't want to see is big drawdowns. Now, it's entirely possible to tweak this system to make a lot more money than I use it to make. In fact, it's trivial, and several students have tweaked the rules to be drastically more profitable. What it's not possible to do is tweak it to be more profitable without more drawdowns. Now, what am I trying to do here? The goal of this system is to be profitable about 4 out of 5 trading days. That's the goal. So to do that, we have to prioritize low drawdowns and taking a number of trades every day. And so I digressed a little bit. Let's go back to the rules. So the rules are, when you see a setup on the 5-minute, once the setup is valid, we do 2 things. The second thing I'm going to cover in a few minutes, but the first thing we're going to do is say, do we have confirming evidence? So confirming evidence is one of 4 types. Do we have let me find it. So right now, this bar here, this was a long trade, and we ask ourselves, do we have a Bollinger Touch on the 5? Yes, we do. We can stop looking. You only need 1 out of the 4 times. Second question we ask is, do we have confirming evidence on the 10-minute? And you can see the bar that touches the Bollinger on the 2 also touches the Bollinger on the 10. So we have confirming evidence. So we're done. You can stop thinking. Now, the inference of the fact that the vast majority, about half of these things, are Bollinger Touches, means that you should check Bollinger Touch first. It's about half the time. Once you have one, you can stop checking. The second most common type of confirming evidence is a trend with a pullback to the moving average. So if we get a long setup on the 2 minute and we see here, we're good to go. We're good to go. Pull back to at least the 8 moving average. It can be deeper. It can be all the way down here within a tick of the lower Bollinger. But as soon as it touches the lower Bollinger, it's a different sort of confirming evidence. Okay, so everyone clear on the first 2 types of confirming evidence, and we can move on. We good? All right, moving on. So the third type of confirming evidence is very simple. Has everyone seen this kind of situation where price kind of walks up the outside of the Bollinger Band, like it does here, like it does kind of here, like it does here? Has everyone seen that recurring behavior like it does here? Those of you who are good with price action, you familiar with that? All right. So this chart is a 10-minute chart. How long does this walking up the Bollinger Band typically last? 3 or 4 bars, 5 bars, can go a bit longer, can go a bit shorter. But I would say 3 or 4 bars is about normal, right? You know, 3 bars, 3 bars, down 4, 5 bars. Malik, this isn't in the price action masterclass course. This is the system that we trade. So yeah, the price action course is about using your skill to read price action and figure out what's the highest probability next. What I did is I took those principles in the price action course and I used them to build a system. And that system is a set of black and white rules. That means you don't need to know any fucking thing about price action, because price action is hard. Like it took me, I don't know, it took me 5 years before I was any good at it. Yeah, it's the prison paycheck. Okay, so let's look at the rules for walking up the outside of the Bollinger Band. Anytime you have a close outside the Bollinger Band, we consider that we're walking out down the outside of the Bollinger Band. So here, this bar, and it's important to understand, this bar on TradingView says 10 o'clock. What that means is that 10-minute bar started at 10, closed at 10 minutes past 10. And that's important to understand. So we consider ourselves to have short confirming evidence until we get a single bar that closes with a low that is higher than the Bollinger Band. So see how this is still touching the Bollinger? We're still walking down the Bollinger. And this bar, we're still walking down the Bollinger until the close of this bar. So we start walking at 10:10 and we finish at the close of this bar, which starts at 11 o'clock, closes at 11:10. So let's look at another couple of examples. So here we start walking up the Bollinger Band at the close of this bar at 2:10. Continue walking up the Bollinger, continue walking up the Bollinger, continue walking up the Bollinger. We check the high of this bar is 691 and the Bollinger high is 693. So at the close of this bar, which starts at 240, ends at 250, at the close of this bar, we stop walking up the Bollinger. So what we need when we're taking a setup is we need some confirming evidence on the 5 and some confirming evidence on the 10. Maulik asks a good question. Should I get the price action masterclass or the prison paycheck system? The system is honestly where I would start for everyone. Price action is like a super advanced for people who want to like really understand markets at a deep level, but it's not the best way to make money. And in fact, any of the people in our platinum group will be able to tell you that the best way to make money is to have a set of rules and to never ever worry about what the charts are doing or why. Just follow your rules. Okay, Ben is asking, what's the difference between a Bollinger touch and Bollinger walking from a practical perspective? Great question. Okay, so Bollinger touch here is short confirming evidence. Walking up the Bollinger Band here is long confirming evidence. So that's the primary difference between the two. Now, walking up the Bollinger is really quite rare confirming evidence. So I don't check for it first. When I'm in a practical sense, when I'm trading it, I check for the first things first. Like, for example, this is the charts unfolding in real time. You can see we've got a setup that's probably going to play out. We need a touch of the Bollinger. We need a higher close, which we're probably going to get in a minute and a half. And then we need a lower close without breaking this low. And then we need confirming evidence. We have a touch of the Bollinger and the 5. We have a touch of the Bollinger and the 10. Now, we have one last thing. Now, if you consider this setup right here, touch of the Bollinger, one or more higher closes, one or more lower closes. Long here, stop loss here. If we have a 1.1R target is all the way up here, right? That is objectively a shitty trade. Because even though it fits the rules of our system, it's still a shitty trade. The market has to get up to here. And not only is it a shitty trade, it's a trade that's going to take, what, it took like 30 minutes to get to here. It's going to take, you're going to be in this trade for another hour or 2 hours. You're going to tie up your capital for a long time. And the implication of this is twofold. One, it's a fundamentally different type of trade. A trade that you're holding for a couple of hours is different than one of these like long here, target here. We're in the trade for like 8 minutes, right? You know, short here, stop loss here, hit the target 2 minutes later, 4 minutes later. So a trade that you're holding for 2, 4, 6, 8 minutes is a fundamentally different sort of an animal than a trade you're holding for a couple of hours. So what happens when you mix those into your system together and say, oh, they're all the same because they fit the rules? They're not all the fucking same. And so what happens when you do shit like that, which is intellectually dishonest, is that you get this thing that we see again and again with trading systems where your back tests don't match up with your forward tests. So has everyone familiar with a situation where you've got where you've had a trading system that should, in theory, work? You've got a back test that says it's going to do really well. It looked good on the back test, and then you go to trading for real, and it just fucked you. The reason that happens is because you're not getting specific enough with your system, or you've blended too much together as a soup. It's probably a little advanced for a first day. Now, the implication of that being a shit setup is we need a way to take out the shit setups. Here's how we do it. It's a little bit more complicated than this, but I'll give you the basic version because we're running out of time, because I'm going to start trading in 7 minutes. And then I'll do it live and show you how we do it. So we institute a maximum target. And Van Tharp, who's he taught me to build trading systems, taught me that you can improve any trading system. Whatever trading system you're using right now, you can improve the fuck out of it by excluding the trades that have a bad risk-reward ratio. It's really, really simple. If you take any system, no matter how average, and remove the trades which are a bad risk-reward ratio, you'll improve it. It's much easier to improve trading systems by just finding the bottom 30% of shit trades and scraping them away, rather than trying to find new and improved edges. So anyway, we institute a maximum target. The maximum target here is the highest high in 25 bars. 25 bars is from the Bollinger touch, by the way. So we go back 25 bars, 1, 2, 3, 4, and say clearly that this is the highest high in 25 bars. And so we need a 1.1R target. So our high here, our entry point is 69.5. Our stop loss is 61. from 61 to 69.5 is 8.5 pips. 8.5 times 1.1 is rounded up or down to the nearest half pip is 9.5 pips. So 9.5 pips from 69.5 is 79. So our target would be from here, stop loss here, target just past the edge of the screen. And we've got a maximum target of here. So we would skip this trade. And that is useful because that would have been a losing trade. Now, let's recap. Our core setup is exactly what we see right here. Touch of the lower Bollinger, a higher close without breaking this low, and then a lower close without breaking this. So this actually looks like it's going to be a setup right now. Was there a setup on the hammer 4 bars after the touch? That's not a hammer, that's a shooting star. Now, as soon as we break the low of this candle, the setup is off the table and we start the count again. Previous setup, this one. Stephen, this one here. Yes. This is a retest concept though, which I haven't covered today, just because we're going to run out of time and it's going to be too much for me to take in on one day. So we're 4 minutes from starting to trade live. So I think what I might do is I'll just do this every week. I'll just teach the system for the first hour every week, and then we'll start trading for real. If there's enough interest in you guys interested in me doing that, I'm happy to do that for everyone if you want. Okay. Well, yeah, let's make it a regular thing, and I'll just teach for an hour before we start trading on a Tuesday. Any questions on that in the 3 minutes we've got before we start trading? Happy to help, guys. Happy to help. Probably take us about 4 or 5 weeks to get everyone up to speed, which is not so bad. Any questions on what we covered today? Okay, good question. The letters we have on this chart are in use for the trend following part of our system, which I haven't covered today, which I'm going to cover later. And I never used to use them, but it's a custom indicator that one of our group programmed. And anyway, it labels hammers and shooting stars for you. And I know the definition. I'll teach it to you next week. But anyway, to get it, you go to Trading View, you hit Indicators, you search and type in capital HG, and it gives you a list of custom indicators. And this one here, it's HG Scalpius H&SS scan, and it's just really handy. It labels the chart for you. You don't have to do any maths in your head. Not that it's hard. Like I traded for a year without it, but you don't need it. But it's pretty fucking handy. And in the members section, there's another. There's ones for MT4 and MT5. Okay, so here we are at 2 minutes 58. I'm just going to take a minute and set up my trading platform. Make sure everything's okay. Yeah, Chris B says it saves you mental energy for when you need it by using the letters. And the way that I feel about systematic trading is that you have a finite amount of attention. And when you use up your attention by thinking too much, it's not there when you need it. So you have to be very, very sparing and conserving and rationing with your attention. And the biggest time this comes into play is when we get into a trade. And once you get into a trade, you're going to, hey, Sherry, how are you, man? Elkin, I'll try this on YouTube for you, but yeah, there's better training in the course, like better training than this. I'm just pulling this out of my ass, dude. Like there's actual proper trading. And it's Andrew Carmichael. Yes, it's capital HG. In trading, you have to use the capital. Okay, so here we are. We've got a touch of the Bollinger. We need step 2, a higher close without breaking the low. We need to check at this stage, do we have confirming evidence? It's obvious we have a Bollinger touch and a Bollinger touch. Now, if we look at this, is this a reasonable sort of a trade? Yeah, it's a reasonable sort of a trade. So what we're waiting on is a lower close. Now, what I want you to pay attention to is you've got to train yourself to keep track of this time up in the top corner of my screen. So you see the bar rolled over at 3 past the hour where I am. I'm in Bangkok. And we have to keep track of the 2-minute bars when they're rolling over. So the biggest problem that people have with trading short time intraday systems is that they don't keep track of time, and it gets to the last second, they go, oh fuck, I gotta, oh quick, and then you get flustered. And when you get flustered, you don't check shit properly, and when you don't check shit properly, you make mistakes. So the way that you want to approach this as it unfolds is to be very, very deliberate, like kind of like the way I think like a pilot with checklists. That's probably the closest analogy. So I'll just say to myself, okay, I've got a 3-step process. I'm waiting on a lower close. Until I get that lower close, I've got nothing to do. Now, the difference between the good traders in this group, and there's in the guys on this call now, there's some really, really good traders. There's a couple of guys who are better traders than me on this call. And the difference between the good guys and the average guys is that the good guys will be prepared to place an order, even though it probably won't be a trade anymore. So as soon as it starts looking even remotely like the faintest chance of a trade, the better traders will prep an order just in case. And if you're prepping orders just in case, you're never going to get surprised. Now, here's how you do your position sizing. So there's a bunch of different ways to do it. This is the dumbass way. You could have your spreadsheets do it, but this is the idiot way. So put in whatever your account balance is and whatever your risk percentage is. So if I want to risk $1,000 a trade, I will start with a 3 pip stop loss value, calculate a position size, write that down on a bit of paper. I much prefer using a bit of paper than a document, just because I want to have it like right next to the screen. I don't want to be flustered. And then I'll do 3.5 and see how that changes slightly. And then I'll do 4. And because I've been doing this a long time, I know all the position sizes off the top of my head, so I don't need to do that anymore. But if you're doing this for the first time, you'd start with 4 and go probably all the way up to about 9 or so would cover you. So here I am, I'm waiting on a lower close. If I got a lower close, which I'm unlikely to get, place an order to go long at the break of this high and the stop loss at the low. So what I'll do now, because I'm trying to be a good trader and trying not to be a lazy trader, is I'll prep an order just in case. And I'll prep that order knowing that it's probably 10% chance of ever having to execute. Like this isn't going to be a trade. And so the entry here would be 62, and the stop loss here would be 55. So that would be a 7 pip stop. And because we're Bollinger confirming evidence, we're multiplying by 1.1 for our target, rounding up or down. So 7 times 1.1 is 7.7, and we're rounding up or down to the nearest half pip. So it's 7 pip risk for 7.5 pip target. And you don't have to think about it. You don't have to do that calculation, because it's always 3 for 3.5, 4 for 4.5, 5.5 for 6, 6 for 6.5, 6.5 for 7, and so on and so on, up until you get bigger than we regularly get. So now I know that I can prep an order on that basis and have it ready to go. Okay, and you can see that this is a possibility of being an order if this closes lower than there. So I've got to prep this. So our entry point 62, our stop loss 55, that's 7. And for me, I've got to prep that order. Okay, so this is an equal close. The close here is 591, and this is an equal close. So we don't have a setup. Yeah, that's a good order to miss. And one thing I'd like to point out is that as you're watching me, that was kind of crappy trading from my part. Did you see how I wasn't quite ready, like at the exact time? So what is good trading? Good trading is having shit all correct when the shit happens. So what I did there was pretty average trading. Like, you can get away with bad trading a lot of the time, but yeah, that wasn't my finest hour. So we're waiting on a lower close. Now, what I want to point out is that if this bar was a lower close, we'd be entering here and not up here. So we have to resize the position, which in one respect is a pain in the ass, but in another respect, it gives us a better entry when it happens. So this is unlikely to be a lower close. We've got 30 seconds to go in the bar, 28 seconds. And I wouldn't redo this order just yet, just because I know that the odds of this happening in 18, 16 seconds aren't good. So as you do it for longer, you get a feel for when you have to really be on the ball and when you can be a bit sloppy. The S denotes a shooting star, and we use that for the trend following part of our system, which I'll be covering in a couple of weeks for you. And a shooting star is a candle that represents a failed attempt to drive the market up. And the exact definition of it is it's a candle with an upper wick, which is this bit part, which is equal to or greater than 2 times the real body. The real body is the colored bit, can be black or white, and a close in the lower half of the range. So you can see all of these 4 candles represent the market trying and failing to go up. Yeah, I don't think it's high and tight at the moment. I wouldn't have thought so. Waiting on a pullback, a lower close. So, so what Chris is saying in the chat is that we have a requirement of a maximum target being the highest high in 25 bucks. And I don't think we have that. Maybe we do, but I haven't looked it up. 62.5 is max. $62.5 is max entry. Thank you, Chris. Appreciate that. So our maximum 1.1 R target can't be further than here. And why not? Because if we've got a target all the way up here, that's a big bet. That's a bet that the market's just like going to totally reverse and make a new leg up. Like, maybe that happens, but if you're making bets on big things, you're only going to be right about 25% of the time. You want to be right about 60% of the time. That's why do we want to be right 60% of the time? In fact, win rate is the least important part of system performance. But if we're going to optimize this for low drawdowns, if we have a system that's only right, 30% of the time, we can have luck really stretch out. You have big long stretches of bad luck. What we're trying to avoid with this system is extended periods of bad luck. I use interactive brokers, Eldon, and I use interactive brokers with NinjaTrader for execution. It's not necessarily because NinjaTrader is the best thing on earth. In fact, it's not. It's like objectively kind of shitty software. I'm just used to it. Plenty of guys use pretty much everything you could possibly imagine. Some guys use TradingView if their brokers plug into it. Some guys use straight interactive broker software. There's Pro Realtime, there's NinjaTrader, there's a lot of MT4 and MT5. Donna, the S and the H, we're not using it today, but to find it, you go to TradingView and search for capital HG. And it's this first one here by Autark Capital, this one. And there's other ones for other parts of the system. I don't use them personally. Chris B has said in the chat that he reads charts on TradingView, trades on MT4, and he's looking at changing to MT5. I really prefer reading the charts on TradingView and then going across to NinjaTrader and executing. I don't know why. I've tried it both ways, and it's technically not the best way, but I prefer it. What do you guys in the Platinum group prefer? Like, NT5, Stephen? Stop limit order is a big deal, man. I would change just for that alone. Okay, so we've got an interesting situation. Kevin, there's a hack for 2-minute charts on MT4 if you need it. There's some bullshit custom indicator that you can use. Okay, so we've got an interesting situation. If we touch this upper Bollinger, we won't have Bollinger touch confirming evidence, but we will have another type of confirming evidence. You can see here that we are downtrending because we have our two-stage process. Stage on the 5, we have touch of the lower Bollinger and then a single candle with the lower low and the lower close. So we're trending down. On the 10-minute, same deal. Touch of the Bollinger, single candle with a lower low and a lower close. We're trending down. So we're trending down and we have a pullback, and that pullback has reached at least the moving averages. So we're good to go. So if we touch up here, we have a setup, but it's not just a setup. It's a fundamentally better setup. It's a better edge. Instead of Bollinger touch confirming evidence, it's trending confirming evidence. Now, it looks like a mean reversion setup, but really it's a mean reversion setup on the M2 chart, but it's in the direction of the dominant trend on the 5 and in the direction of the dominant trend on the 10. So it's fundamentally a completely different sort of an animal. And we treat it differently. We're going for 2R instead of 1.1R. And we're going for 2R, but moving stop to break even at 1R. Everyone got that? So hopefully we get a touch of the upper Bollinger. Now, from a price action point of view, you can see that this is a very large range bar, and it's opened at the lows, closed near the highs with an expanded range. So what that tells us is that the bulls are in control and they're increasing their control. Now we see almost no overlap in this bar between the previous bar. Now here we have some significant overlap. The market has tried to go down and then closed higher. So the bulls are still in control, but they're weakening in control. This range, smaller than this range. This range is even smaller again. So the bulls are here, but they're weakening. And now what we see is a strengthening of the move. So when you see strength at the end of a move, what does that represent? When we see strength at the start of a move, it tells us that the big money is getting positioned ahead of the move. When we see strength deep in a move, typically what that means is that the guys who didn't have the guts to go long here finally get the guts to go long here. Now they're sure. So these are late coming retail traders. So the smart money gets long before it's an obvious thing. Once it becomes the classic mistake in trading is to wait until you're certain. And you can see visually what's playing out here is finally these guys who didn't have the guts to get long here, finally they're like, oh, fuck yeah, it's going up. And they get long here. And you can see immediately the selling pressure coming in. If this paints a setup for our rules, this is a very nice setup for us. Julian Cassidy says, I use TradingView for the charts and place the order on my platform. That's my preferred way to. Okay, so here we go. We're at 14:21 past the hour, we need a lower close and then a higher close. Might not get either of those. So what I want to point out to you guys is that the beauty of trading with a system instead of just pulling it out of your ass is that you don't need to think. You don't need to get confused. Like if any of you have had bad experiences or failing experiences trading, almost certainly it's just very difficult to do on the hard right edge of the chart. Like it's very difficult to know what's the right thing when you're under this crushing pressure. You've got thousands or millions of dollars on the line, and you've got to make the right decision. You've got to know what to do. It's like it's very, very stressful. And the way to make it less stressful is to have a set of rules and to never break those rules. Like, in fact, I should probably break my rules a little bit here and there. Like, I should probably break my rules more than I do. So, as a general proposition, beginner traders can improve their performance by putting more system into their trading and less thinking, less discretion. And experienced traders can generally improve their performance by putting a little more discretion and a little less system. So as my guys in the Platinum group get better, I encourage them to use various strategies for using very, very small amounts of discretion. And there's a couple of ways of doing that, but we're probably going to get a setup in 2 minutes time. So we'll just keep an eye on this. So we're waiting on a higher close or a shooting star, which will be labeled with an S like that. And you can see, we were talking a couple of bars ago when this was all the way up here, how this extended range bar after a move was a sign of people FOMOing in at the last minute, like now they're sure. And this is usually a sign that we're going to get at least some selling pressure. It doesn't mean you can predict the future. It just means that you can see that this is capitulation to the upside, creating a temporary exhaustion of selling. Now, let me prep this order and I'll explain the psychology behind how all this works. So our entry point here would be the nearest half pip below 69, which is 68.5. And a stop loss be the nearest full pip above 72.9, which is 73. So stop loss 73, entry 68.5. That would be 4.5. 4.5 for 9. Okay, so as soon as this breaks the high, this order is cancelled. So what did that tell us? It told us that, yes, there was some selling pressure, but buyers jumped in. So by waiting for this touch of the Bollinger lower close, higher close, we avoid taking many, many losing trades. So what we're trying to do is wait not until just we have an opinion that the market's going to reverse here. Like I had an opinion that the market could have reversed there, but my opinion was wrong. My opinion is often wrong. So you want to wait until the market confirms your opinion by breaking the low of the candle of the setup bar. Okay. So we are trending up. Do we have a Bollinger touch? On the 5 minute, the Bollinger is 757 and the high is 755, so we do not. So we could still get a reversal here. It looks to me like this market wants to go up. Now, just because it looks to me like the market wants to go up doesn't mean that it's going to go up. And it doesn't mean that I'm not going to take short setups. I take every setup. It's just like, even though sometimes I'm taking a setup that I know is not going to work, it's just easy to take. It's easy just to pick every cherry, right? Eat some bad cherries here and there. That's just the game. Okay. According to our definition, we're trending up. Every time we get the highest close in an uptrend, we check, does it do it on an uptick or a downtick in ATR? If it's on a downtick, we go into what's called decreasing volatility mode, which I'll cover in a week or two. And D'Artagnan, that white bar is seriously engulfing. Yes, it is. That is the very definition of an engulfing bar. And what's it telling us? It told us that the shorts tried to take control. It looked like they were good for a minute, and then the bulls just stomped over the top of them. It means the bulls have serious control. Okay, so every time we get the highest close in the trend, once you go down to this ATR, sometimes you need to drag it up to make it clearer. And we check, did this happen on an uptick or a downtick? So from the previous bar to this bar, it was an uptick. And Chris B has pointed out that we are now Bollinger touch confirming evidence. And what that means is that if we do get a short setup, which is actually unlikely, we're going to be going for 1.1R instead of the 2R. Right. Yeah, I think this, okay. There's a chance this might be a shooting star completing the setup. So I'm just going to prep an order just in case. The entry would be 75.5, stop loss 79, 3.5, 3.5. Okay. Okay, this bar is at 21 minutes, 26 seconds past the hour. If it closes as a shooting star, which will be conveniently labeled with an S, but it's obvious when you look at it like that is a shooting star. It's, and now it's not. If that closes as a shooting star, that will be a setup and we'll take that short. It's an unappealing short. CE, Donner are confirming evidences. We have 4 different types of confirming evidence. And we need one of the 4 on each of one of the 4 on the 5 and one of the 4 on the 10. The 4 types are Bollinger touch, trend with a pullback to moving average, walking outside the Bollinger bands, and decreasing volatility, which I'll cover in a week or two, depending on how fast we go. All right, there's a pretty good chance this is going to be a setup in the next bar. What do we need for a setup? We need either a shooting star or a higher close than here. So our close here is 72.6. We need a higher close than that. Now it's 72.9. So I'll prep this order just in case. So our stop loss would be 72. Our entry point would be 72, sorry. Our stop loss would be 79. So I'll be risking 7, and I happen to know off the top of my head what that position size is. So risking 7 to make 7.5. Probably not going to be set up now. So keep an eye on the time, and we're 10 minutes past the minute. Sorry, 13 seconds past the minute. So who here hasn't seen this before? Who is this your, who here is the first time exposure to systematic day trading? Okay, so we need, okay. Elton, anyone else who's first time? Jackie, first time? Carl, okay. So the Rabbit, first time. All right, that's cool. So the thing I really want you to take away, David, is that imagine if you were just trading these 2-minute charts and just trying to decide at every step, should I be long, should I be short, should I be long, should I be short? Oh, let's go, quick. This would be very, very difficult to do, even as an experienced trader, even as someone with a decade worth of experience. It would be a total concentration exercise. It would be really fucking hard. But by putting rules around this structure, this is scalping. And scalping is taking a lot of different trades that are very small wins. So when you're scalping, you never go. A scalp is a quick bang. So anyway, if there's one thing I'd like you to take away, it's that it takes it from being virtually impossibly difficult to being really not so bad. Like, and Julian said not just difficult, but an emotional roller coaster. And so what happens when you decide which trade you want to take, you are a loser if you take a bad trade, and you feel like a loser and you have bad feelings. And one of the things we do when we're trading is that we try and avoid bad feelings and have good feelings, which is just a terrible thing to do. Possible 11 for 12 here, from Chris. Is this high and tight? So the 12 from 68 would be 56. Looks high and tight to me. Just Elton, discretionary scalping is extremely difficult, and extremely difficult. Like it's like, and I'm understating it. Like just discretionary scalping to decide when to jump in and out all day. I don't think I'm good. I'm good enough to do it on one day. Like I could do it. I could probably get my mind right and jump in and impress you and show you how good I am. And I could probably do it for a couple of hours. Could I do it for 8 hours? No way. Could I do it 5 days in a row? No way. And so what happens typically, unless you're world class, and I know a couple of people who are world class. Like if you want to see a world class scalper in action, my buddy, he's on Twitter. He's called Mr. Yen, and there's another guy called Al Brooks, has a YouTube channel. Both of those guys are. And a wonderful lady called Linda Rashke, who was very good to me. All of those people are world-class scalpers. But I'd like a sort of trading that you don't need to be world-class. I don't want to be Michelangelo. I want to be a house painter. That's the way I think about it. Yeah. So my opinion is, if you're going to do something for a long time, you can't. Like I'm having a shitty day. Like my buddy's dying in the hospital, and I've been thinking about him all day, and I've been crying and shit, and I've been grumpy and sad and angry. No way in the world am I in a fit state to trade discretionary scalping. You'd have to take it off. Okay, so we're waiting on a higher close. And we have to check our risk-reward ratio. The maximum target is here. So remember, we've got a 3-stage process for our sell set. 1, touch of the Bollinger. 2, 1 or more lower closes without breaking this high. And now we're waiting on a higher close. And then we work out our 1.1 on a target. And it can't be below here, which is the lowest low in 25 bucks. So what are we doing there? We're putting a whole pile of structure and rules so that it doesn't come down to, I think this and I think that. And Chris is pointing out that this is my favorite type of market structure right now. And the easiest type of market structure to trade is what we call a sideways high volatility day. And you can see that our volatility is measured by ATR, it's substantially higher than it was back earlier in the day. And you can see clearly that we're neither uptrending nor downtrending. In fact, we're going sideways. And so when you're in a sideways high volatility market, it becomes very, very easy to trade, because markets have a strong tendency to tag the upper and lower boundaries of any of any channel. So, you know, you can get long here and be pretty sure it's going to get to at least up here. You know, if I got short here, I'd be pretty sure that it was going to get to around here. Now, I don't think this is going to pass our risk reward filter. Let's check it. So our entry point would be 66.5. Stop loss would be 79. It would be 12.5 for 14, 66.5 minus 14 is 52.5. It's all the way down here. It's too far. So what we're doing by instituting our risk reward filter is excluding the trades that have a target that's too far away to be realistic. So we need a bit more of a pullback. Now, this setup can go on for up to 20 bars, not including this bar. So 1, 2, 3, 4, 5, 6, 7, so on and so forth. Just going to go to the bathroom. I'll be back in a minute. Righty. So everyone get what we're doing? We're waiting for an entry that has a target that's above here. It's probably going to happen in 2 and a bit minutes time, I'd say. So when we get an entry, actually, this is kind of important to understand. So when we get a sell setup that doesn't fit our risk reward filter. So let's run the math on this setup. The entry point here would be 67. The stop loss would be 79. So it would be 12 for 13.5. So 67 minus 13.5 is 53.5. And that puts it here. So it's not quite, this is our maximum and the target is here, 53.5 down there. So it's no good. So what we have to do is we have to wait until it comes and gives us a better entry up here. So we just keep checking it every bar. So when this situation happens, until either 20 bars expire or we break this high here, we've got to be on high alert. We've got to be like paying attention.
Hey Scott, I'm sorry to interrupt, but if it keeps on going down, so we might be we might have a potential long from the.
We might have a potential. 3, 4, 5, 6, 7, 8, 9, 10.
They're just 2 bars, but if it keeps on going down somewhere around 52, 63, then
yeah,
I would say there might.
I think that's going to confuse people if I cover it right now, but I can't, honestly, I can't see that happening in the next couple of bars. It's like, could happen, like it's, yeah, definitely possible. How are you, Sherry?
I'm good, Scott. I'm good.
Nice to hear. Elton, yes, it's an exact set of rules to copy every day. And so the way to learn this system is to check against the system results. And you go through a day and figure out which trades you thought we were taking according to the rules. And then check what we actually took. And there's like screenshots for every trade. So you can pick a trade and go, okay. So you pick a trade at random, it's touch of the Bollinger, higher close, lower close, long here, stop loss here, confirm, and it's got it in the spreadsheet. And if you had one that I didn't, or if I had one that you didn't, one of us must be wrong. And it often happens that I'm wrong. The guys in the Platinum group all have edit access to the sheet, and they'll often correct me if I'm wrong, but things don't go uncorrected for very long. So the idea is that if I'm teaching you to trade, but I'm teaching you to trade based on my however many years of experience and my skill and whatever, and that's bullshit, because you can't actually replicate what I do. Like, if we're going to have a system, it has to be a real system. You have to be able to get exactly the same as me, not just one day, but every single day. Like, we all have to be able to do that. We all have to be able to get it right. Otherwise, it's just total bullshit. Curtin, can you explain how you use ATR as a stop loss? Yes, I can. So there's part of the system which I haven't covered yet, which is the trend following part of the system. So in a market like this, we don't really want to be going counter trend. We want to trade alongside with the trend. And so we have a setup that is a trend following setup. And it's what we use these hammer and shooting stars, the H and the S's for. It's inherently difficult to place those orders because you never know when something's going to close a hammer until it closes, right? And so I prepare for that by looking at the ATR. And for example, at the time when this hammer closed a H, if I go down to the ATR, it was 0.00035. What that means is that the average candle size was 3.5 pips over the last 14 days. So what I will do when we're trading trend following, which I'll cover next week, which is a very specific and only happens 12.5% of the time. So you could happily go a while without it. When we're trading trend following, I will prep an order based on roughly where the ATR. So the ATR here is 0.000314, which means an average pip size of 3.14. I prep a 3 pip stop order. Candy, the moving averages we use in the trend following part of the system, and which I haven't covered yet. So hopefully we'll get to that next week.
But we need to check this for high time.
Yeah, we do need to check this for high time. Good point. Okay, 67.5 and 79. 11.5 for 12.5, 67.5 minus 12.5 is 55. And the low here is 55.3. So it's just not quite. Close, but not quite. I'll show you, Curtin, I'll show you what I mean by the so let's take this trade. So you can see it's a H for a hammer. It's a 4 pip range. And the confirming evidence is walking up the Bollinger, walking up the Bollinger. And so you can see this trade here is a hammer. We have confirming evidence. We're walking up the Bollinger on the 5 and we're walking up the Bollinger on the 10. But this closed like in a 2-minute candle is really difficult to notice until the last minute. So if I go down here and look at the range, the ATR was at 340, which is 3.4 pips. So I would probably have prepped an order for 4 pips and then just adjusted it on the fly, just so that I have something to go on. Which brings up kind of an interesting point. My priority when I trade is not necessarily getting it exactly right every time. My priority is making sure I don't fucking miss any trades. Nothing will fuck with your head more than seeing a trade that you should have taken, that was a trade according to the rules, that you should absolutely be on, and you missed it, and then it's a winner, and you feel like an idiot, and there's no one to blame. It's all on you. You feel like an idiot, and what invariably happens is you start trading like a fuckhead. And so what we see time and time again is that one mistake can set off a cascade of mistakes where you start behaving like an inexplicable noodlehead and just doing dumb shit that you would never do. So the way to avoid doing dumb shit is to not make the first dumb mistake. And what we see when we do our reviews with people is nearly always the first mistake isn't really that bad. The first mistake is kind of like oh yeah, that's not so bad. And then they make another mistake, and then they get flustered, and then they're starting to make bad mistakes, and then they've missed a trade that was a winner, taken a trade they shouldn't have traded that's a loser, tried to make it back, and it all unravels. So Chris B says they kill the spirit. Yeah, they just suck the soul out of you. And the reason it sucks the soul out of you is if I have a system and my system tells me to take a trade and that trade is a loser, it doesn't actually feel like I'm a loser. It feels like the system's a loser. I don't even take it personally because, hey, it's not me. Like, in fact, you can blame me. It's much easier for you guys because you can say, oh, that fat cunt over there, it's his fucking system. It's not mine. But if you decide to take a trade and then it's a loser, there's no one to blame. You can't blame me. You can't blame the system. You can't blame anything but your own self. And it makes you really feel like really bad. It makes you feel really bad about yourself. So it looks unlikely that we'll get this set up here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It could still happen. We've got 20 bars, not counting this bar, 1, 2, 3, and so on and so forth. So it could come up here. That would be a pretty normal thing for it to happen. You want to, when you're trading the system or any system, you want to absolutely prioritize mistake minimization. If your system is legit and you don't make any mistakes, you will make money in the long term. That's just like absolutely guaranteed. That has to be the bedrock of your understanding. If you trade the system well and your system is legit, you will make money. So over time, just for most of us, it just comes from just getting beaten up so much by the markets. Like I'm just not gonna decide to do my own thing anymore. I've just touched the stove too many times. I just don't want to touch the stove anymore. I know it's fucking hot. Hey, Alex, Scott, if there is an upward decreasing volatility trend, does a touch of the lower Bollinger touch the trend, or do we wait for the ATR to be exceeded? Really good question. If we're talking about decreasing volatility mode, and some of you aren't going to understand this, so don't sweat it. It's a more advanced topic. We're gonna get to it, don't worry. So let's say we go into decreasing volatility mode here. Once you're in decreasing volatility mode, you're in decreasing volatility mode until you're out. You can stop trending. You don't need to maintain, you don't need to stay being in a trend. What throws us out of it is either breaking a new pivot too high in ATR or making the highest ATR value for the trend. You can actually stop trending. And in fact, it's kind of good sometimes when it stops trending after you're in DV mode. Good question. So when you're not quite feeling right, like I'm not feeling very good today, how do you approach that? You know, if you're sick, like let's say you got the flu, or you got the Rona, or you have an argument with the wife, or, you know, like my friend is dying today, and I'm not feeling right, how do you still manage to trade and do your job? So the way that I approach it is there's a threshold. Once you go over that threshold, can I do my job or not? Like if I'm like a blubbering mess, or if I'm angry, or whatever, there reaches a point where you just can't do your job anymore, and you just have to have the wisdom to say, whoa, too drunk to drive here, like hands off, right? Just hand over the keys. Below that threshold, you can still be able to do your job, firstly by acknowledging that you're not at your best. So an easy way to still trade at an acceptable level, the easy way to trade it as an acceptable level when you're not feeling at peak performance is to acknowledge that you're not at peak performance. You know, to say, okay, I've got some stuff going on today, I've got strong feelings, and you want to give yourself a little bit of extra buffer. And the buffer that we have in this system, the complication is this time, these 2-minute bars are always rolling over in 5, 4, 3, 2, 1, new bar now. So if you want to make this easier, you stay on top of the time and get earlier. That's how you do it. So there's two aspects of it. Aspect one is feel these feelings and don't deny them. Anytime you're denying any sort of feeling that you're having and you're trading, you're in massive danger. All of the greatest mistakes of my trading career have been around avoiding feelings. And secondly, we just give ourselves a bit more time. So Timeless Man is saying not thinking or saying that you feel wrong, which means that's a really interesting point. Labeling a feeling as bad and good or wrong and right. Happy when you win and sad when you lose are two sides of the same shitty coin. You know, as long as you're running away from unpleasant experiences and running towards pleasant experiences, you got some problems in your life. Like that's just a poor life strategy. Having tried it before. Jen, Oanda is the one that I've seen people use with TradingView. I believe they're working on an interactive brokers integration, but yeah, actually, let's check and see what. I know, top brokers in TradingView. Oh, they've got TraderVote. TraderVote's a really cool broker. Yeah, any of those. If you're looking for a market to trade and you're not absolutely wedded to FX, I would prefer to trade futures. Futures has a number of advantages. The commission structure is much lower, and commissions are the biggest problem with scalping systems. So, okay, are we at 20 bars? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 5 more bars. I don't think we're going to get a setup here. So something that just occurred to me is that we've been going for nearly an hour and we haven't placed a trade. But we haven't been doing nothing either. Can you see how there's many decisions to make, many calculations to make, many orders that we've prepped, stuff that's kept me, you know, emotionally engaged and like concentrated, but we still haven't placed any trades. On average, you're going to place a trade about every 45 minutes. Have a trade, sorry, not place a trade.
You watching this one, Scott?
Sam, 10, 11, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Okay, so we have 20 bars to complete a setup. This looks like it's going to be a setup. In fact, I know it is. I don't have to calculate it. We have confirming evidence. We have a Bollinger touch here, here, and here. And so we need to prep this order. Okay, and the low is 69.4, so the entry would be 69. The stop loss is 79. So 69 for 79 is 10. 10 times 1.1 is 11. So let me prep my order. Now, if you'll notice, it's 46 seconds late by the time I got my order placed, which is objectively shitty half-assed trading on my part. That's what I mean by I'm not feeling at my best. That's what happens when you're not at your best. It just takes you a bit longer, you know, just not quite at your best. So you've got quite a lot of slack when you're trading systematically instead of discretionally to just give yourself a bit of extra time and smooth it out. Okay, so if this order is not filled, which it may very well will be, we've got 25 seconds to go, I'll drag the order up to the low of the next bar. I won't, in this instance, cancel the order and replace, even though it's technically I should, because my number one priority is making sure I don't miss a trade, because there's nothing worse than missing a trade that you should be on. Okay, 5 seconds, 4 seconds, 3 seconds, 2 seconds, and 1, and right. Okay, short at 69.5. Everyone short? Okay, now because I used my old order, I just dragged it up. It's half a pip out, so I just have to adjust that. Now, 3. Make sure my target is in the right place. Is the target 58.5, guys? I'll look it up.
I reckon it's 59.
Yeah, I just eyeballed it. I didn't calculate it yet. Oh, yeah, 59. Right. So our target is here. Stop loss is here. See what happens. No, we're not in DV mode, Graham. You can only be in DV mode when you're trending up. We started trending up here. So we started trending up on this bar on an uptick. Check the highest closing trend, it's still on an uptick. We can't be in DV mode until we get a higher close than here. David Selim, the stop loss is up here at 79, sorry. And the target is, where's my target? 59, which is here. Target here. Stop loss here.
He's got a basic question here.
Hey, man.
If we get the high and tight at the 20th bar, let's say the 20 bar from the Bollinger touch is high and tight. So do we keep the order open to get filled at 21st or 22nd bar, or is it stop?
No, we do not. So 20 bars and no more. So
If the order is getting filled at the 21st bar, we're not taking that.
not taking it. So the way I want you to think about the rules is to make the most literal dumbass interpretation that you can. So if you read the rules and just read like exactly what the rules say, the rule says we've got 20 bars, 21 bars, it doesn't fit the rule. So, and it's like that with everything. Like we're not, we want to get our opinion out of it as much as we possibly can. Okay, great. So decreasing volatility mode is not about ATR falling. And the reason for that is that while we're in a corrective phase, ATR should be falling. It's entirely normal for ATR to be falling while it's doing this. What matters is if we have a so Graham, to be in decreasing volatility mode, you have to be in a trend first. And then while you're in that trend, you need to have a single close, which is the highest close in the trend on a downtick in ATR. And you can see the only two closes we have, which are the highest closes in the trend, are this one and this one. And this one happened on an uptick in ATR, this one happened on an uptick.
Scott, any final decisions on changing the time frame?
Yeah, so what I've got to do is run it on the sequestered data that we've taken out. So I just got to find the time to do it, and hoping to get it done before the start of next week. So who thinks this trade is going to work? No fucking idea, exactly. Yeah, I think it's a coin flip. Okay, so there's a good point that we can make at this point is what really decreases your trading performance is staring at this too much. You don't want to, once you're in a trade, now is your time to go get a drink, take a piss, have some food, do whatever it is that you got to do. It's not a good practice to watch a trade once you're in it. In fact, it's an extremely, extremely harmful practice. So if you're watching my face, you'll see I try and do my best to like not look at it like it's gonna work or it's gonna not. And we have this illusion that you can control it by watching it, or there's some excitement to be gained, and that's just not the case. Like every second that you're looking at it, you're detracting from your potential.
So it's got on the sort of the more the advanced question,
Sure.
the previous Bollinger touch we had back, black candle back, I don't know, 23 candles ago or something.
Sorry.
Right.
Say
So
that,
the upper Bollinger touch, the black candle,
Yep.
that one there.
Yep.
From there to the next Bollinger touch was 19 candles. The next upper Bollinger touch was
Yep.
19 candles.
Mhm.
So once that happens, now to be in a trend, do we now have to still break that high from 20 something candles back? Or do we
Okay,
have to
so-
just break that high there?
So to be in a trend, this is a really good question, an advanced question. To be in a trend is breaking the most recent high. So we don't need to break this one. We have a two-stage process. The most recent Bollinger touch is the reference point. So now we're in a trend.
Even if it was less than 20 candles ago
Correct.
from that.
Correct.
That's because to stay in a trend, obviously we were considered to still be in a trend. I think, were we?
I think
Actually, no, we did
we
drop out of the trend. We dropped out of the trend there.
Dropped out of the trend and back into here.
Yeah, we went below, above, below, so it took us out. So
Oh, shit,
to
I'm
make the
stopping.
question a bit redundant.
Yeah, hit stop loss for everyone there. Yeah, that's a really cool question.
Yeah, so when you go that 19 candles and you had that next Bollinger touch, that therefore meant we were still in trend because we had a Bollinger touch again. Then are we then
No. It's 20 candles without making a new high. So
I thought it was all a Bollinger touch. That's what the original rule said. I thought.
I don't think so. I'm willing to be corrected, but I don't think so. Let's come back to that in the Platinum group.
Yeah, all good, man.
Okay, so if we close at the highest close in the trend on a downtick in ATR, which looks like what we're going to happen, we will be in decreasing volatility mode. Right, so we might get another setup here. Probably a good time to pay attention for me. And I just had a little moment there where I could feel myself like, oh, how much longer do I have to do this? I'm not really, I fucking like this. Yeah. That's a good time to pay attention. So where is our maximum target? Lowest low and $25. Okay, so I'm going to prep this order. Entry 76, stop loss 81. So that's 5 for 5.5. Just prep it. Alex, no, we're not in decreasing volatility mode yet. Because we only started trending on this bar. We need the highest candle in the uptrend with a downtick on ATR. So even though ATR is going down, it's perfectly normal for ATR to go down while we're doing this. It's not normal for the market to go up with ATR going down. So we have a close, lower close. So we don't have a setup.
It's a higher close for me, Scott.
Is it? Then you should place the order. Okay, so this is an interesting close 70, close 70, so equal close for me. So FX is not a real market. Every FX broker is a little bit different. Futures markets is a real market and everyone's the same. Stock market, real market, everyone gets the same data. Your FX Alex, what platform are you using? There's the standard MT5 one is not the actual Wells Wilder definition of ATR. They apply a moving average smoothing to it, so you need a different one. It's in the members section, or I'll if you email Jennifer at scottphillipstrading.com and ask her for the MT5 ATR indicator, she'll send you the proper one. The default one has a moving average over it, which makes it smoother, but we don't want smoother. That's why we're here, man. We can get all these little things smoothed out. Holy shit! I've got a higher close on Interactive Brokers as well. So if I was taking my setups off Interactive Brokers, which I'm not, I'm taking the setups off TradingView and placing them on Interactive Brokers.
This one could be.
This one could be. All right, so let me prep the order.
No, level equally going to watch.
This one's starting to smell a little better, I think.
Scott, this has to be the difference on various brokers, but I'm using FXCM, so are you, and all of these other guys on TradingView, we're using FXCM. So on a single platform with a single broker, it has to be the same. Why is it different on one broker?
You're asking the wrong guy. These are philosophical questions.
Yeah, we've observed this over the last 3 or 4 months,
Yeah.
Shreya, that there is just a difference between there's 8 of us all on FXCM TradingView, and we're all getting different results.
The truth is that FX data is inherently screwy. They retroactively change it every now and again. FX data is just not, it's not a real market, man. It's It's like made up pretend. So can I explain how it's been different for, like we've had times when I've been like with Chris trading exactly the same data feed and we've got a different thing. Like it just shouldn't happen. And some of us have been around the ringer with TradingView support, which has been really unsatisfactory, and they just deny there's a problem, and it's just yeah. What I suggest you do is that in the long run, none of that makes much difference. It's all about sometimes it's gonna be lucky for you, sometimes it's gonna be unlucky. Just trade off the data in front of you and don't think about anyone else's data. So the easy way around that is to not think about anyone else's shit. Just whatever's on your screen, trade off the screen you've got. You've only got one screen. Set up his Bollinger touch the lower close. Okay, Jan, we've got a Bollinger touch. We need a lower close without breaking the high of this candle. We have that lower close. It can happen in the same bar, but it also happened here. Now we're waiting on a higher close without breaking this high. So this looks like it's going to be a setup to me now. And that would be an entry of 75.5, a stop loss of 81, 4.5, 5.5. Okay, minute to go. This kind of looks like it's going to be a setup to me. Okay, Jan. Okay, so this is an interesting question. I'll cover it quickly. So we're waiting on a lower close without breaking this high. Once we break this high, we start the count again. So we've got Bollinger touch, lower close, higher close. Then we break the high and we start the count again. So as soon as we break the high, we're not retesting the high anymore, and then we start the count again. Is that clear, Jan? Okay, 20 seconds to go. And I'm getting ready to place this order. I'll try and do it properly for at least once today. So that's what it is. 9, 8, 7, 6, 5, 4, 3, 2, and placing order now. That's the way you should do it every time. Order to go short at 1.2275.5, and so order to go short here if we break this low. So this is an important thing to understand, David, is that if I just jump in and go short there, it's not a very appealing trade at all. It's kind of a shit trade, right? Once the market breaks this low, that really is a game changer. And you wouldn't want to go short, like jump in short market right now, would you? Like that, it looks like we're going up. But these setups are based on the idea that if participants are expecting it to go up and instead it goes down, when that happens, it catches people by surprise, and that surprise causes an overreact. Now, the biggest influence of these setups is not the actual setup rules. They're not like magic or anything. At least 60% of it is simply the fact of breaking the low of any given candle gives it a probability of being lower in 4 candles, up to 4 candles later. So I had a student who built a fully automated system based on these, but he threw away all my setups, and he just had, if it breaks the low of the candle, I'm going short. And he had a bunch of filters and stuff. It was a complicated system, but he got very good algo trading results.
Ready to move your entries.
I'm going to be a bit lazy, but I'm just going to drag my order up. Okay, here we go. So I think it's going to be the same order. Okay. moving it up a half a pip to 76. Okay, short. Okay, and you can see the reaction once the market did what we thought it might do, but looked like it was a low probability outcome. And you could see the sharp move down as traders get caught by surprise. We'll see what happens. Maybe it works, maybe it doesn't. Now, what I want to do every time I get into a trade is double check because I didn't get the position sizing exactly right. So I should be short at 76.3. That's half a pip away. Okay. Let's see what happens. The stop loss is at 81 and the target is at 70, I think. I didn't move my order up fast enough, so my take profit is still half a pip further than it should be. Yeah, looks like another loser for today. Chris. Yeah, Chris, you're right. We need to clarify that, so which we can do. So I'm having strong feelings about this trade. I'm having feelings like I just don't want to be here, like strong feelings of aversion. Rabbit, people who trade multiple markets, I don't personally. The people who trade two markets at once say that it's easier to stay concentrated. Stop loss here, no loss in trade. Well, that's annoying. The people who trade two markets at once say that it's easier to not get distracted. There's technical problems with trading any system on multiple instruments in that any trade that you enter at around the same time is inherently correlated, and almost any system will paint setups on multiple instruments at the same time, just because markets all reverse and do their thing together, right? All right, we may get another setup. Chris B says it's definitely easier to concentrate on two. When you're choosing pairs, you want to find the ones that are the least correlated you can. Now, we have the highest close in the trend. We need to check, is it on an uptick or a downtick? So it's on an uptick, so we're still okay. We're still taking short trades if we get one. Now, what I'm feeling is the strong desire to like, oh, fuck, I've lost two in a row. That sucks. I want to stop. Very bad place to give into your emotions and stop, like just because you want to, like I'll take one more trade, win, lose, or draw. And Chris says that even Euro USD and NQ are correlated to an extent. Absolutely. So when you trade multiple markets, you need a methodology for deciding which trade do you take. For example, if I was trading NQ and Euro USD, if I had a trade set up on both of them, and one of them was a long on NQ, I'd trade the long on NQ, just because stock markets have an upward bias and the odds are slightly tilted in your favor going long. That's the kind of methodology that would make sense. Yep, what you typically find when you trade multiple markets of anything is that the drawdowns are slightly higher than you expect, and the money you make is slightly more than you expect. So what it means is that the good periods tend to be really, really good, like amazingly good. Okay, we have another highest close in the trend. We're on a downtick in ATR, so we're not taking mean reversion setups anymore. Instead, we're looking for trend following setups. Timeless Man, I wonder if combined opinion about where the price is going is an edge. It's a very interesting thing. Some of the retail brokers keep records of it, and they trade against you when it gets extreme. Sentiment is an edge only at extremes. Sentiment is not an edge 95% of the time until everyone is all, like in 2017, sentiment, everyone was bullish on Bitcoins for a whole year, and then at very extremes, when you couldn't go down the street without hearing someone talk about Bitcoin, then it was a reversal again. So sentiment is really quite difficult to trade off. When you try and trade off sentiment, what you find is that we've got a bunch of primate DNA. We really are like monkeys who wear shoes who don't think we're monkeys. And there's very strong pull of the herd. Like if you've ever owned stocks when they're crashing universally, you feel like it's okay if everyone else is losing money too. And it's the same with houses, and it's it's emotionally very difficult to go against the herd, which is why it's an edge. So what stops us from being in decreasing volatility mode is breaking what's called a pivot too high. Pivot too high is an ATR value with two lower ATR values to the left of it and two lower ATR values to the right of it. Okay. I've just got a whole range of unpleasant feelings going on, like anxiety and sadness, confusion, amusement, anxiety. So let's unpack that a little bit. That's kind of a useful skill in trading, as a useful skill in all trading, not just systematic trading. Sometimes when you're sitting in front of the screen, you're going to feel really strong urges, like I want to get in this trade right now, like this is it, like let's fucking go, or fuck, I don't even want to be here, I can't even watch this. It's helpful to just name those feelings. Just giving them a name stops you kind of being embedded in them, and then just pay attention as to what comes next. And what you see is that every feeling sort of, it's not a static. It's like it comes, they all come and then they all go. And just paying attention to them stops you from getting trapped in them. And the problem with trading and emotions is acting out on them. Okay, from Javier, we went into DV at 424. Is the ATR we used to confirm when we're out, the ATR question. This 422. So the way that we check is it, has it got two lower values to the left of it and two lower values to the right of it, which is here. So the closest one. So as soon as we break ATR value here, we're back taking shorts again. And you can see exactly why. Like right now, this is not a good time to be taking shorts.
A hammer here would be a good setup.
TV off.
Indeed. Okay, so now we're back taking shorts.
Scott, any update on skipping the Bollinger confirming evidence trades with lower ATR value?
Not as yet, man. I'm gonna do some work and I haven't had the time. So the process for it is we've got some data that I didn't do the calculations on, and one sec. We've got a bunch of different data of other people who are trading different markets. So what I want to do is test the theory against other data that we didn't use to develop the theory. So when we're doing that, actually I'm going to prep an order. So I'm actually target lowest low in 25 bars. Shoot, we're going to work 76 and 84 is 8 for 9. All right. Work that out. Okay, placing order 76. Okay, order placed. You may be right, may not be confirmation. So the Bollinger is 843 and the high 838. No confirmation. You are correct. No trade. Thank you very much for that, Alex. That was nearly a mistake. So the mistake that I nearly made that Alex saved me from making is that we didn't have confirming evidence. And you can see that how that happened is I was rushing, I was behind the 8 ball, and I didn't do a last check. I assumed and it made an ass out of me. That'll be $10. Please, you probably saved me some money there, dude. If there's, if there's one thing that would ruin my day, like absolutely, I wouldn't be able to sleep tonight, is making a mistake. A mistake should be so rare that it's like a big deal. It should be like, I can't believe that actually happened today, kind of thing. And it's useful when you, so effectively I made a mistake, even though you guys caught me, it was still a mistake. So when you make a mistake, it's useful to unpack how that happened, because then you have the opportunity to address it and make sure you don't make it. And the method I use to address mistakes is that I keep asking why. So I'll go, okay, I didn't notice that there was confirming evidence on the 5 minute. Why not? So I didn't do a last minute check. Why not? Because I was rushing to get the order placed. Why was I rushing to get the order placed? And I think, truthfully, why was I rushing to get the order placed? Because I wanted to place a fucking trade. Why did I want to place a fucking trade? Because I've had 2 losing trades, and I really, really, really wanted to have 1 losing trade, 1 winning trade, salvage some pride so I could turn off the screen and get out of here. That's what was really going on for me. When I stripped the bullshit out of it, I made a mistake because I wanted to take a trade. Like I wanted this trade to happen. So anytime that there's bad stuff going on, you just keep asking why and going deeper and deeper and deeper and deeper until you figure it out. And you go, okay, well, why was I trying to make 1 more trade? Like, why should that make any difference to me? Like why am I doing that? And the answer that's underlying that is, I'm not happy with taking 2 trades and having 2 losers today in front of you. So why wasn't I happy with taking 2 losing trades in front of you all? Probably because there's some ego shit involved. And so once we unpack it and just keep going deeper and deeper and deeper and deeper, you can see the sort of the stupidness of those kind of, and the childishness of those reasons. Right? I have plenty of egotistical bullshit, Julian. You need to talk to my wife. So interesting situation. We could come down here, touch this lower Bollinger, which is actually a much better setup because going in the direction of the higher time frame trend, right? Or we could come up here and touch this one up top again and make a lower a reversal setup. It's interesting to see which one you prioritize, like which one you're kind of hoping happens. And you kind of get a sense of like whether you're most people are either like an optimist or a pessimist nature. Like most people are more comfortable with going against the dominant trend or with the dominant trend. It's very rare to find people who are comfortable with both. Alex, a walk up the Bollinger Band is closes outside the Bollinger Band. Yes, it starts at the first close outside the Bollinger Band and continues until, for example, if we're looking here, it starts at the close of this bar, which started at 420, close to 430, and it ends at the first bar where the high of this bar is lower than the Bollinger. If it's an equal touch, if it's still touching, you're still in walking up the Bollinger Band. No, Alex. So a close above starts it, and then what finishes it is a bar with a high lower than the Bollinger. Okay, so we've got an interesting situation happening here. It seems likely that we'll come up and touch the Bollinger again and probably paint another setup. Julian says, I prefer a touch of the lower Bollinger, but really I should just be neutral and follow the rules. Probably an important thing to understand is that when you feel like you have a preference for one side or the other, that whole, like, I've just got to trade like a robot and follow the rules. Yeah, you have to, but denying that you feel that way is also the cause of future mistakes. So if you feel like going long and you hate the idea of going short here, just say it. Like, I don't want to fucking go short. Like I think that's a crap trade. Like it just takes all the, it takes the emotional heat out of it, because at least if the trade's a loser and you didn't want to take it anyway, so it doesn't hit you. So for the more advanced guys, there's an interesting situation that might come up here. So we've got a touch of the Bollinger on 2, and that still has 20 bars to play out. But there was no confirming evidence now. But what happens if we get confirming evidence? Confirming evidence for a Bollinger touch is put your cursor on the bar that makes the Bollinger touch on the 2, and one bar either side of that. So either this bar or this bar. So we, even if it touches the upper Bollinger, here now we have no confirming evidence, or we start the confirming evidence again. So we have to start the setup process again. Good night, Chris. Yeah, if we don't get us set up in the next sort of 15 minutes, I'm going to go for the family too. My wife's had a long day looking after her. Our nanny has gone back to the village for a week, and it's really difficult with no nanny. I don't know how people in the first world do it. Questions, stuff that's not clear. All right, guys. Actually, I'm gonna turn in for the day. Oh, it's a long day for me. Thank you very much for your time, guys. And yeah, if you want the rest of the system, I guess for the next couple of weeks, I'll just be teaching it on Tuesday. But if you want it now, you just get one of my emails, and there's a link to buy it if anyone wants it. Yeah, happy to help. See you guys, and yeah, thanks for stopping by. See you, Graham. See you, Javier. And I'll just paste the link in the chat if anyone wants it. And, all right, guys, I'll see you next week.